For the last 3 decades, the prevailing narrative of the Australian economy has been one of an uninterrupted streak of prosperity. Standard macroeconomic indicators, like headline GDP growth and employment rates, appear to validate this claim of exceptionalism. However, recent data reveals a critical anomaly that fractures the mainstream story. This chart shows Australia's economic growth. While the blue line of headline GDP remains positive, the orange line, real GDP per capita, has plunged below zero since 2019. Individual wealth and living standards have decoupled from the national growth figure. This negative divergence indicates a deep structural exhaustion that began well before the pandemic. Traditional business cycle analysis fails to account for this decay. To understand the true stakes, we have to look past standard economic modeling. Mapping the impending shift requires us to look beneath surface indicators and identify the long-duration macroeconomic waves that dictate the economy. This framework tracks 3 distinct rhythms from 1991 to 2030, the Kondratiev, the Zhu Jintao property cycle, and the Ziegler cycle. These overlapping cycles functioned as the localized engines that drove Australia's modern era. The prosperity of the last 30 years occurred because these 3 waves synchronized in their upward phases at the same time. By building this model layer by layer, the evidence suggests that the simultaneous exhaustion of all 3 cycles signals a transition into a restrictive new economic regime. The 1991 recession serves as the genesis point for this era, marking the start of aggressive financial liberalization and inflation targeting. This was the start of the 5th Kondratiev wave, a global macro trend of financialization that Australia integrated into. The mechanical driver of this wave was a structural decline in borrowing costs. This curve of exponential decay represents the multi-decade drop in interest rates. This continuous drop in rates increased the borrowing capacity of the average household year after year. Banking deregulation enabled institutions to maximize the use of this new credit capacity. This environment of low inflation and high leverage provided the necessary soil for asset inflation. Much of Australia's modern wealth rests on the singular, now exhausted foundation of the Kondratiev low rate cycle. The Kondratiev rate cuts ignited the Zhou Jintao cycle, a localized property phenomenon that typically lasts 20 to 25 years. Layering this onto our framework shows a steep ascent through the late 90s and 2000s, reaching a peak near 2022. Mass migration and international student inflows provided the demographic drivers for this curve, concentrating demand in major cities. The scale of residential expansion during this period transformed the urban footprint of Australia's major capitals. Government tax structures, specifically negative gearing and capital gains discounts, turbocharged this demand. These policies changed the market's focus, turning basic shelter into a tax-advantaged financial asset. Household leverage surged as residential real estate became a primary speculative retirement vehicle for many families. These policies resulted in one of the most property-dependent economies in the developed world, linking the banking system to housing debt. The third layer of the model is the juggler fixed investment cycle, which typically operates in 7 to 11-year increments. The most significant of these investment waves for Australia spanned from 2003 to roughly 2013. Unlike traditional juggler cycles based on domestic manufacturing, Australia's cycle linked directly to Chinese industrialization. This phase saw unprecedented capital expenditure in heavy infrastructure, specifically iron ore and LNG export facilities. This dynamic explains why Australia avoided a recession in 2008, while the rest of the developed world collapsed. China's unprecedented post-2008 economic stimulus package created a voracious, unrelenting demand for industrial raw materials to fuel rapid expansion. The resulting surge in resource revenue stabilized government fiscal conditions and shielded domestic banks from the stress seen overseas. Australia's stability through 2008 was largely sustained by the stimulus of a foreign superpower. A critical turning point arrived after 2013, as Chinese property growth slowed and the mining investment boom peaked. A significant loss of productive capital expenditure followed. The Australian economy pivoted to housing-led growth to replace the loss of productive capital. This created a structural distortion in the banking sector, where profits became reliant on residential mortgage issuance. Household consumption began to rely on the wealth effect of rising home equity rather than wage growth. property transactions became a primary wealth generator for the nation, replacing industrial output. This economic model requires constant asset price inflation to maintain baseline household spending. The 2013 pivot reduced Australia's productive industrial base, leaving the nation dependent on the continuation of the property supercycle. The timeline has now reached the threshold of 2022 and 2023, where the effects of the 2013 pivot have reached their limit. The macro perspective of the last 30 years reveals a dangerous alignment occurring on the right edge of this diagram. All three nested cycles are now turning downward at the same time. The structural drivers of the past era, falling rates and credit expansion, are exhausted. Because these three waves are aligning downward, the economy is entering a period of structural repricing that will likely last for decades. This new reality is the sixth economic regime, characterized by the onset of the Kondratiev of winter. The architecture of this regime is defined by the intersection of structurally higher inflation, severe demographic bottlenecks, and supply constraints. The debt accumulated during the property upcycle now acts as a weight as interest rates normalize. Servicing this legacy debt will consume capital that would otherwise support productive growth or innovation. Escaping this trap requires the dismantling of the financialized property architecture that created the appearance of prosperity over the last 30 years.